Recessions can be scary times for investors as the stock market tends to get very volatile and the economy contracts. However, recessions also present opportunities for those who know how to navigate them properly. In this video, we'll cover some key strategies for investing during a recession as well as which sectors historically perform the best when the economy is struggling. What is a recession? Before we dive into investing tactics, let's quickly define what a recession actually is. A recession is a widespread economic downturn that lasts for several months. Technically, it's defined as 2 consecutive quarters of negative economic growth as measured by gross domestic product or GDP. Other characteristics of recessions include high unemployment, low or stagnant wages, falling retail sales, and contracting business revenues and profits. The importance of having a plan. When recessions hit, investors often panic and make emotional decisions like selling off all their stocks. This is usually the wrong move. The smart investors have a plan in place to not only protect their capital during downturns but also capitalize on the opportunities that emerge. Having that plan ahead of time and sticking to it is crucial for successful recession investing. Strategy 1. Diversify across asset classes and sectors. One of the most important strategies is to diversify your investments across different asset classes like stocks, bonds, real estate, and commodities. You'll also want to diversify across different sectors within the stock market. This way, you can minimize your overall risk and protect yourself if one particular industry gets crushed during the recession. For example, during recessions, consumer discretionary stocks that sell non-essential goods and services tend to suffer. However, consumer staples companies that sell food, beverages, and household items usually hold up better since people still need to buy those essential items. Strategy 2. Look for undervalued quality companies. Recessions provide opportunities to buy shares of high-quality companies at temporarily depressed prices. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." When the herd is selling indiscriminately during a recession, patient investors can scoop up shares of industry leaders and dominant businesses trading at much more attractive valuations. Look for companies with little debt on their balance sheets, strong cash flows, and durable competitive advantages in their industries. If you buy these types of high-quality companies when they're undervalued, you'll likely be rewarded once the recession ends and the economy improves again. Strategy 3. Increase your exposure to defensive sectors. As mentioned earlier, certain sectors of the market tend to fare better during economic downturns. So it makes sense to increase your exposure to these more defensive areas. Some of the top defensive sectors to consider include healthcare. People still need medical treatment even in recessions. Healthcare companies like pharmaceutical, biotech, and medical device makers can hold up relatively well. Consumer staples, food, beverage, household, and personal product companies continue seeing steady demand for their essential offerings. Utilities. Utilities provide necessities like electricity, gas, and water that everyone needs in any economic environment. By tilting your portfolio more towards these defensive industries, you can reduce your overall volatility and risk during turbulent recessionary periods. The best sectors in the last recession. To illustrate which sectors actually perform best, let's look at how different areas of the market fared during the Great Recession from 2007 to 2009. The top 3 performing sectors in that period were: 1. Consumer staples, 15.1% decline. 2. Healthcare, 22.5% decline. 3. Utilities, 36.6% decline. While those sectors did decline in value, their losses were much smaller than the overall S&P 500 index, which plunged over 50% from peak to trough. On the flip side, the worst performing sectors were: 1. Financials, 83.9% decline. 2. Industrials, 67.8% decline. 3. Information technology, 60.9% decline. Those areas were absolutely decimated as the credit crisis wreaked havoc on banks and other lenders, the housing market collapsed, and business investment dried up with the economic freefall. Key takeaways. In summary, here are some key points to remember about investing during recessions. Have a plan and stick to it, don't panic. Diversify across asset classes and sectors. Look for quality companies trading at bargain prices. Increase exposure to defensive sectors like healthcare, consumer staples, and utilities. During major downturns, defensives tend to hold up best while cyclicals get crushed. While recessions produce scary, volatile markets in the short term, they also open up opportunities for disciplined, value-oriented investors who know how to navigate them successfully. If you follow strategies like these, you'll be able to protect yourself and potentially profit when the economy does eventually recover.